Hello. In this video, we will learn the treatment of warrants and ESOP in the DCF modeling. I have already created the video on how to perform DCF, which was a basic introduction, and I feel you should watch that before this video. Along with that, I want to thank because that video performed really well, better than my expectations. So thank you for that. Let's get in the video. So, before we jump into the treatment, a little differentiation and introduction to what warrants and ESOP are. So, they are quite similar, but the person to whom they are issued and the objective behind issuing them is different. So, ESOPs are basically issued to the employees, which kind of motivates them to get attached to the company because they get the ownership interest in the company. So this generally have like employees have an option to purchase the stocks after a certain period, which can be 5 or 10 years. It is generally less, which is known as vesting period. So after that, employees can exercise the option and they will get the shares. Same is the case with warrants, but they are issued to investors where they buy the warrant and after certain time before the expiry of that warrant they can exercise the warrant and get the share. So warrant is for investors and ESOPs are for employees. Plus another thing to note is that ESOPs, in case of ESOPs, you will get the amount, the exercise amount. Exercise amount is the price that you pay for getting the stocks that the employee will pay to the company, which is generally less because ESOPs are issued at discount. Whereas warrants price are higher than the market price when they are issued. So in warrants, you make the payment now. Like to purchase the warrant, you make the payment now. Whereas for options, if you exercise in future, then only you will be making the payment. So there is also the difference in the time when the actually payment is made for purchasing the stock. Along with that, warrant, the objective is to raise capital. See, like if any company do not want to issue shares at this point but want to raise capital, in that instance they will issue warrants. Along with that, they are bucketed with other instruments like preference share and debt instrument like debentures. So it is used in that way. Warrants are kind of less common in India, but you will get ESOPs in most of the companies. In our case, we will analyze it in Infosys, which have lot of options, so it will be better to understand in that company. So, as we have already got the basic introduction, what warrants and ESOPs are, we will directly jump into the treatment. So, the method used is treasury stock method. Okay. So now coming to treasury stock method. So first point is whether the option is in the money or out of the money. So what it means, if the exercise price is less than stock price, in that case, there are likely chances that the option will be exercised. Suppose if there's a thing, suppose A, which is actually priced at rupees 100 in the market, and you are getting that thing at price 80 rupees. So of course you will be buying it because you can purchase it at 80 and sell that at 100 in the market. So this whole situation is known as in the money. And if that's the case, there are likely chances that the option will be exercised and we will include that option in the number of shares. But how to include that we need to understand. In the last video, what I did that all the options were in the money, so I directly added that to the number of shares outstanding. But the more advanced and accepted method of doing this is the treasury stock method. So the assumption that we make in this method is that company will use the proceeds to buy back the shares from the market. What I mean by proceeds is that the exercise price. Like if the options are exercised, so they will be paying the price, the exercise price that will be decided. And we will see what is exercise price and all in the actual example on Infosys. We will perform that actually. So that is the amount that will be received by the company. So company will use that amount to actually purchase, or the better word would be buy back the shares from the market and the balance number of shares. So suppose that the number of options that are in the money are 100 and the exercise price is 5 rupees and the market price is 20 rupees. Okay. So the amount that will be received by you is the 5 rupees exercise price into the 100 number of in the money options. So the total amount will be 500. So you will use this 500 to purchase the shares from the market. So how many shares can you purchase from the market? 500 divided by 20. That would come to around 25 shares. Okay. So out of 100 shares, 25 shares can be directly buy back from the market using the cash that is received from the options that are exercised. Got it? And the balance 75 shares will be the new issue. So our outstanding will increase by this amount 75. This is the whole process. And I hope you got it. Uh, uh, and if it's not, we will do the example and then it would be more clear. The point that initially came in my mind when I was studying about it was that why we are making this assumption that we will buy back from the market. We can directly add the cash that we received in the cash in the equity value and increase the share outstanding by the number of in the money options. So in that method also the final answer, the price per share, sorry, value per share will be almost the same, but there's slight misrepresentation if we do it in this way. That is that it will increase the equity value. Suppose any company is issuing n number of options and then all became in the money and you took that cash from those options and added that in the equity value. So your equity value is overestimated or overshown. And when you compare that with the market cap, that do not give the fair picture. So instead of adding that money in the equity value, we adjust that money directly in the number of shares outstanding. So I hope you got the logic of why we are not directly adding the cash to the equity value, because it will be type of overvaluing the equity value. If any person is not analyzing the per share price or the value per share and it is actually seeing the equity value, you are kind of overvaluing the equity value because any company can go on to issue n number of options, and because of that the equity value will increase by that amount. So that's the point of doing this whole process. Now we will actually do this in Infosys to make it more clear. So now we will perform this in Infosys. Infosys do not have warrants, but they have lot of options. So first of all, we need the number of shares outstanding. So this is the annual report of Infosys, and these are the number of shares. Sorry. These are the number of shares outstanding. I will just directly add this number over here. Next is in the money options. So I will search for RSU. Uh, these are employee stock options. Let's see, there will be a table on this. This is the table that I was looking for. So there are three plans, and we need to take this outstanding at the end of 2025. So I'll pick this number. Uh, all have different exercise price, so we will be doing it separately. And the last is this. So yeah. Next, we need to take the exercise price. I don't know what's happening. It's not copy pasting. Like it is 499 if you see over here. This is 499. So these are the exercise prices and the number of shares that are in the money. And how I know they are in the money? If you see here, the current market price is around 1500 rupees. Okay. So the exercise price is less than 1500, so it is in the money. Okay. So all the options are in the money, first of all, that we need to keep in mind. Next is that we need to calculate the total amount that will be received on exercise of these options. So what I can do is uh, I will apply some product function, and the first array is this, second array is this, and uh, this is the amount that will be actually received by the company. So now how many shares that can be purchased with this much amount? So this divided by the market price. So around 57,000 shares can be purchased from this amount. And what is the total number of shares? We need to add these three. Okay, so I will just write here amount received from exercise of options. Okay, and these are number of in the money options, just taking the total of this amount. So it is sum of these. So these are the number of shares, and around 56 shares are uh, met by buybacking the shares from the market, and the rest will be the new issue. So the new issue will be these much number of shares, around 1.5 crore. Okay, so the share outstanding will be this plus, sorry, this plus this. So these are the number of shares. Uh, so yeah, these are the number of shares. And to be true, it is very close to what we did, because see, we take this amount in crores. So if you convert this number of shares in crores, it will come to around 416 crore shares. And this is the actual number of shares that we have taken in the last video as well, because the exercise price is so small that the net impact is very less. So that's why I have directly taken the I have directly included all the in the money options in the last video. But this is the actual method that should be used, and it is more accurate and advanced. So hope you like this video. Thank you so much.